Business News now. Will Finance Minister Pravin Gordhan be able to say enough tomorrow to stave off an investment downgrade at the end of the year? All eyes will be on him when he presents his medium-term budget policy statement in Parliament. Treasury has largely taken the lead to convince credit rating agencies and investors that South Africa just needs more time to get its house in order.
Pravin Gordhan, together with Business and Labour, has over the last few months been tirelessly lobbying for South Africa with rating agencies. The Finance Minister previously said there was more than a 50% chance that the country could avoid a downgrade this year. Rating agencies will be closely watching the medium-term budget speech for signs the authorities remain focused on fiscal strengthening.
For them, the most important message would be, yes, they know we have great policies and, the MVP and the Industrial Policy Action Plan and a whole bunch of initiatives in place. But are we actually implementing it in a way that, in fact, at the end of the day, does lead to economic growth?
Ratings agency Moody's recently stressed that political divisions are the country's major weakness. The problem is uncertainty about policy direction and whether political tension will impede structural reform, undermining South Africa's credit rating.
I think the political noise has been very disappointing and very corrosive. And the last time, I think the rating agencies were particularly worried about the extent to which politics would impact on policy adoption.
So how close is South Africa to being downgraded to junk status? Rating agencies look at a number of variables to determine a sovereign debt rating. Of particular importance is the potential GDP growth of the economy, trends in per capita income, the country's external balance, notably the current account balance, the level of external debt, institutional strength, including sound rule of law and protection of investor rights, as well as changes in the domestic debt ratio and inflation. The country's GDP recovered from a fall of 1.7% in the first quarter of the year to an increase of 3.3% in the second quarter. Better trade data and the possibility of improved agricultural production, although moderate, appears to be on the cards for next year. Our GDP per capita level is declining and potential growth is low. We have been running a relatively large current account deficit. However, this declined from 5.3% of GDP in the first quarter of the year to 3.1% in the second quarter. The country's external debt remains stubbornly high. The strength of institutions such as the National Treasury and the South African Reserve Bank bodes well for the country. The Treasury has built a solid track record in recent years of sticking to its expenditure ceiling. The Treasury's intent and willingness to stabilize the debt ratio and return government's finances to long-term sustainability are clearly illustrated in the actual and projected decline over the next 3 years in the primary budget deficit. Inflation is expected to peak in late 2016 before slowing through next year. This bodes well for the short-term interest rate outlook. Maybe, just maybe, this helps South Africa stave off the drop to junk status. Issues that government needs to address are curbing the public sector wage bill, the nuclear power project, the health insurance scheme, the fees must fall commitment, and financing of state-owned entities. Pundits say what South Africa badly needs is political leadership and a national implementation plan that goes beyond fiscal policy. The IMF forecasts 4.6% growth for emerging markets next year, but only 0.8% for South Africa. The rating agencies are expected to review the country's rating in December, although they may get this done sooner. John Bailey, Johannesburg.
More Money Matters. The JSE will be back at it at 9 o'clock this morning, but for now let's take a look at the movement of those currencies and commodities.